Live. So welcome to another week of YieldLab DeFi AMA, where every week at 3 p.m. UTC, we go over DeFi strategies in Web3. And this is a chance for anyone in the audience, whether you're listening from the Twitter live stream or from the YouTube live stream, ask questions in the chat. Let's figure out Web3 together. It's a communal space for us all here to learn. Don't be afraid of asking questions. There are no stupid questions, and we're gonna work through things together. Usually I live stream, share some applications that maybe have updates, usually focused on the Neutron ecosystem, but they could be from anywhere in Web3. And so without further ado, let's jump into it. I do just want to make one post from Twitter to make sure that our live stream is getting out there, so just bear with me 1 second. Okay, so I was asked a few different questions this week. So there are a few strategies that I want to kind of remind everyone of, that they exist and how to set them up and how to think about them. So two of those strategies are, one of which is basis trading or delta neutral strategies, and another is leverage looping. And so if you've been around, you've probably heard of these terms before, and they're becoming increasingly popular, especially something like basis trading. Given the current market, we've seen a pullback in BTC, and people are getting like wrecked on alts, and with the Bitcoin pullback, people are like, okay, how do I survive in this market? One of the ways you can do that is just by farming with stables, and so that's like the most basic thing to do. Assuming you don't go into something that's too risky, a protocol that has too much risk, the token that you're using, the underlying token USDC, will have no price movement. So you won't be able to capture any upside, but you also won't capture the downside when assets go down. And so something like finding 5, 6, 7% APR in stables is beating the TradFi return rate for USD. And so that's a way that you can use on-chain to outpace TradFi yields. And so that's with USDC. Then you can get a bit more complicated. You can use different strategies that give you only net exposure to USDC or market neutral exposure, but you're capturing more than 6, 7, 8% APY. And so in that case, you're still maintaining market neutral exposure, but you're able to capture higher yields. And that's kind of the idea of basis trading. And so if you're familiar with Athena, they did this, and that's how their stablecoin, it works with USDE. And what they do is they hold spot exposure to assets like Bitcoin and Ethereum, and I think Solana, and then they short those assets on perpetual exchanges. And so you're going long 1x, so you're holding spot exposure to certain assets, and then you're shorting them on perpetual exchanges. And this works because usually the crypto market is long. Like, people want to be long the crypto market. And so they're willing to pay to go long on perp exchanges like Hyperliquid, Binance, 2IDX, Mars. And so in order for these people to go long, then there need to also be people that are going short to balance out the order book. There are different mechanisms that different exchanges use to balance these things out. But usually what happens is people that take the short side of the position are paid some amount of funding rate by the people who are long. And so what that means is if you're holding spot exposure is long, and then you're getting paid to go short 1x exposure, you're market neutral. Doesn't matter if Bitcoin goes up, Bitcoin goes down, you are holding equal exposure. That's what's called being hedged. And then what you're earning is the difference between, what you're being paid is the amount that you get from shorting these assets. And so Athena does this. That's how they make their stablecoin. And then they tokenize the strategy into a stablecoin and then put all the yield into the stablecoin. So sometimes it's higher yield bearing than others. And then people get to speculate on this token with things like Pendle and yield splitting. So then there's the principal token and the yield token. So I know I'm going fast there, but these are all different layers of DeFi that are built on top of this strategy. And Athena has billions of dollars of TVL, so this is a proven strategy, and it's really brought on-chain by more liquid perpetual markets, on-chain liquid perpetual markets that allow people to speculate on going short, going long, and collecting these funding rates on-chain in a much more transparent way. And so this is something that anyone can do. You can do it across different exchanges. You can do it across different protocols. You can even go long one perpetual on one exchange and short the same perpetual on a different exchange. But since each perpetual exchange has different funding rates all the time, then you get to capture the difference between these funding rates while staying market neutral. And so to like really capture the profits of this, you need to be on your toes. You usually need to have a bot network where you can automatically open up longs in one place, shorts in another place. You need to manage your LTVs very well, because if you have two different positions on two different exchanges, one goes up and like hits the stop loss, you need to close the other one because you need to remain market neutral for both in your position. Remaining market neutral is the important part of this, because what you're trying to do is earn yield on using DeFi, but not being directionally exposed to any of these assets. And so in the past, we've talked about doing this on Mars protocol. And so in my opinion, it's really the easiest place to do this on. It's also the most capital efficient place, because you don't need to manage LTV. You don't need to manage stop losses or take profits, because everything happens in one application. So you're not managing cross-chain, different platforms. Like we saw in the October 11th crash, a lot of people were automatically forced. It's called ADV, automatic deleveraging. And so if that happens on one exchange but not the other, you're not hedged anymore. And so then you start to take on market risk. With Mars, you're able to do both sides of this trade in the same application. And so you don't need to worry about cross-chain infrastructure. The other side of that is you can really make more profits out of it if you set up the bots like I was talking about to automatically balance your position. And so I'm going to explain how to do this without setting those bots up, just so you understand the concept. And then you can go and make your own bots for balancing it, or go identify arbitrage opportunities on different exchanges. What we teach here is the idea, the strategy, and then it's up to you to optimize it. So I'll check the questions if anyone has any questions, or if anyone's showing up. Appreciate it. Looks like we have some people in the YouTube. Eddie, Odie, Travis, Blanco. Thanks guys. Welcome to the channel, and thanks for coming. If you have any questions, of course, always let me know. And let's see if anyone's joining us from Twitter. Tabcoin Maxi, welcome from the Twitter. Nice to have you here. Okay, let's go to Mars and check out how to do this strategy. So here's the Mars protocol. It's on Neutron, which is an L1 blockchain. Currently, it has a big campaign going on for Bitcoin finance. That's a big focus of Neutron right now, is turning BTC into a productive on-chain asset again. Normally the only way to profit off of Bitcoin is you just hold it and the price goes up, that's worked out very well for people. But you can't be earning yield on it, especially if it's on mainnet BTC. It just sits there. So there's been a big push to bring Bitcoin on chain on Ethereum and other chains in wrap BTC forms, and how do you get yield on it? And so this is a topic for perhaps another time in the video, but Neutron is bringing Bitcoin finance into reality, so you can earn yield on your Bitcoin. Let's open up Mars and talk about how to execute the basis trade. If Mars loads, that would be fantastic. Awesome. Okay, so this is my demo account. This is Mars. This is what you'll see when you open it up. We're on the Neutron chain. You can confirm that by here in this top right corner, in the Neutron chain. Our wallet is already connected, so if it's the first time using this application, just connect your wallet, and you're going to have to go ahead and mint a credit account. Now, we've already minted a few credit accounts. Most of them are empty except for this one. Let's see what the current strategy we have here is. Okay, let's open up a new credit account. I'll come back to this one. So here, I've selected this credit account, and we're going to fund it with some USDC. $20 of USDC. So what we're going to do is I'm going to show you why Mars is the most capital efficient place to do this basis trade. And I'm going to do so with two different assets. I'm going to do it with BTC and with dATOM. Okay, so now we've funded our account with 20 USDC. And then you can go up here to the top right corner and we can check out the perps markets. So here we're looking at perps. We have BTC, we have Akash, Cosmos, Bera. We have a bunch of different markets to choose from. But what we need to do is we need to look for assets that we can hold spot exposure and also short them on perps. And so this platform, Mars Protocol, they don't have all these assets that we can hold spot exposure to. The ones on this list that we can hold spot exposure to are Cosmos, Bitcoin, Ethereum, Neutron, Celestia, and I think there are a couple others. So let's go through the perpetual markets and look for what is currently paying. If I short a token, what am I going to be paid for out of those tokens I just listed? So, okay, let's see. dATOM has a negative funding rate, so this actually will not work right now because this means that if I go long, then I will actually get paid. So the other direction. And this is normal. Like oftentimes in perp markets, you have changes fluctuating every 4 hours. Like on KuCoin, there's a 4-hour funding rate. In one 4-hour segment, you might be shorts paying longs. The next is completely reversed. And so that's why having things like a bot network makes it easier to manage and much more efficient. Okay, here's an example. Okay, so here we have a Bitcoin market and it's paying 19% APY. So if I short Bitcoin on Mars, I will be paid 19% APY. Okay, so we can actually go ahead to our other credit account and set this up. So let's go to the other account. I said here, this account has $37 of wrapped Bitcoin. Great. So now I'm going to go to the perps and I'm going to short the same amount of wrapped Bitcoin. So this is what I'm looking for to short this amount. Let's see if I can just copy this button. Great. So what this is going to do is open up a short perpetual position, which is equal to the same exact amount of dollar value of my wrapped Bitcoin currently. Okay, let's short it. Okay, so while that transaction is going through, the result of this will be what we were talking about previously. I am 1x long Bitcoin, and I'm also 1x short Bitcoin. My long exposure is by holding this spot asset, wBTC, and my short exposure is by shorting on perpetuals. So I'm no longer market exposed to the price of Bitcoin. Bitcoin can go up 2x right now, or it can go down 50%. I won't care. I will have the same $37.73 that I started with. But then you're like, why would you do that? Because I'm farming 20%, 19% APY. So you can treat this position, my long Bitcoin and short Bitcoin, as essentially dollars, like USDC exposure. And so can you imagine getting 19% APY on stables? Like that sounds amazing. And so that's how you can kind of increase the yield that you're earning off of stables by not just farming with stables, so not just LPing or lending USDC, but also engaging in DeFi strategies like this basis trade. This is exactly what Athena is doing, except they're doing it in a less efficient way. They're doing it in a less efficient way because in Mars, I can do everything in this one credit account. My wBTC is my collateral for my perp position. And so I can even open another one in the same account where I have Ethereum spot long and Ethereum short. And so that means there's no wasted capital. My collateral is a part of this DeFi strategy. And that the difference is something like on Athena, maybe they're holding Ethereum on one chain and then they're shorting Ethereum on Binance or something. And so on Binance, so in order to short that Ethereum, they need to post up some collateral. And so that collateral is not exactly being useful in the strategy. And so that's why that starts to cut into the capital efficiency of your strategy. But let's keep in mind, this funding rate is not going to last forever. Currently, there's more longs than shorts. And what that means is the funding rate will continue to stay positive. It will continue to be good in our direction for our strategy. But that could change. Maybe tomorrow a bunch of Bitcoin shorts will come in and the funding rate will flip. And so that's why, again, you have to monitor this and exit and enter your position. Ideally for us, it stays like this for a long time because there's always fees that you have to pay to open a position. And so you need to make sure that the fees that you pay by opening this position are offset by the profitability of your strategy. So this is how you can do it with Mars, a basis trade. But then I was saying, like, one step further, right now our collateral is actually earning interest, and this is earning 14% interest right now because probably people are borrowing wrapped Bitcoin to then put it into the Bitcoin summer campaign that I was mentioning earlier. But usually just lending wrapped Bitcoin earns you 1% APR maximum because most of the time people are not borrowing wrapped BTC. And that's because, well, that's a whole story, but there's no inherent demand to borrow wrapped Bitcoin because no one's shorting it. There's not many arbitrage opportunities. There's no natural inflation like this for the US dollar or for like something like Ethereum staking rewards. And so there's not a lot of borrow demand. Most people are using it as collateral and borrowing against it. So the borrow rates and the lending rates for wrapped BTC are usually, for Bitcoin, are very low. But you can imagine if you had a liquid stake token for something like Bitcoin that was auto compounding, then you can see how this strategy just gets even more profitable. Because, and we can picture this right now. So we're earning 14% APY on our collateral right now. And so you would add this number together with, be the total profitability of your strategy. And so right now on this strategy, we're earning 14% plus 19%. So 33% APY on stables. That's great. And let's see how long that lasts. It won't last forever, but for the time being, this is a good farm. So then you can do this with another asset. Let's see if there's other tokens that we can do this with in Mars. Because remember, every perpetual exchange will have different funding rates, will have different tokens that it can list. And so, you can even scroll down this list. Okay, Bera. Bera has a really positive rate. So if you short Bera, you'll be earning 137% APR right now, but you can't hold spot Bera on Mars. So you would have to go buy Bera on another platform. Maybe you go to Hyperliquid and you buy some, or not Hyperliquid, maybe you go to, another chain where Bera chain, and you buy spot Bera and you just hold that there. But you'll have to put up some collateral in order to short your Bera and manage your take profits and stop loss very well. Another way to do something like a basis trade is just fun. You don't hold spot. You just hold 2 perp positions. And so right now, we're being paid 19% to short Bitcoin on Mars. And maybe if you go to another exchange, the funding rate is different. And you can open up 1 long on one exchange and 1 short on another. The idea is you're doing these things in tandem and in balance. So all of your positions are one side and the other, they're equal. But you're earning a funding rate or you're earning a lending rate, which makes the position profitable. So yeah, that's the idea of basis trading. Thank you, Eddie, for asking me about it this morning. So, reminding me to come back to it. Yeah, I was going to say, and in Mars, there's even other ways you can play this. So let's go back to the credit account that we just funded. And we were looking at dATOM, right? It has a negative rate. And so you can actually farm this negative rate also. So this is like getting a bit more advanced, but what you would do is you would borrow dATOM for 8% APR and then sell it. So that means that you're net short on your dATOM position. And then you would go to the perp trade and you would then long dATOM because you always need to have one side on each. So you can borrow the dATOM and sell it. That means you're short on dATOM. And then you go long on the perp exchange. And so that means you're still market hedged, neutral, yet you're farming this 25% APY. Again, these numbers change rapidly. You should also look at the open interest on each of them to decide how much size you want to go in with, and that will help determine, how long you're in and with what size. So there's really a whole bunch of different basis trades you can do depending on which applications you want to use, which risk parameters you want to use, which tokens you want to trade with, how much size you want to use. And so these are really like all the questions that you need to think about when you're opening a basis trade. And depending on how you answer those will help inform you, okay, like is there a strategy, is there a possibility right now for me? And then that'll help you decide whether you enter or exit. There's also managed strategy. So say this is, sounds too complicated for you and you don't want to manage it. There's something called vaults here. This is specific to Mars protocol. You can go to vaults, and this vault right here, delta neutral, I actually manage this vault, and so it's doing what I just described, but only local to Mars. And so the managed vaults on Mars restrict the managers from doing anything outside of Mars. So they don't let you take any funds away from Mars. You can use the constraints of Mars to perform certain actions to then return those profits to the depositors. And so this vault has like almost 100,000 in TVL, and I do what I just described to you within the constraints of Mars. So buying the spot tokens for exposure and then shorting the tokens on perps and farming that rate. And the goal is to get a higher APY than just lending USDC on something like Morpho or Aave, which is like usually 5 to 6% APY. And so historically, it's done very well. And recently, there's not that many traders on Mars, and so the profitability has come down a bit. But the 90-day average is still like 23%, which is good. So does anyone have any questions here on basis trading in general as a strategy, or have you done it before? And I'm curious to hear what you think about the strategy. Okay, Eddie, you're asking, how do you access a demo account on Mars? I don't know if you can access demo accounts. Maybe on testnet they have something, but you'd have to ask in the Mars Telegram if like they have something like that. Otherwise, just practice with small amounts. You can fund a credit account with something like $5, and then you can still do these same strategies with less money and see how you do. Good morning, Lewin. Okay, cool. Okay, let's go back. Okay, so we talked about the basis trade. We talked about different ways to do the basis trade, whether it's with perpetuals, with spot exposure. You can farm a positive funding rate. You can also farm a negative funding rate. You can arbitrage between two different perpetual exchanges. Great. So let's move on to our next strategy, which I wanted to talk about, which is leverage looping. So leverage looping sounds scary, but it's not. And what it is, it's first of all, it's already a proven strategy. It's got billions of dollars on Ethereum in this strategy in the wrap state ETH leverage loop. And so let's explain what that means. So on Ethereum, you have wrap state ETH, which is an auto compounding token. Where's the yield coming from? The yield comes from the staking rates of Ethereum. So that's like, what, about 3% or something? And so if you're holding wrap state ETH, you're earning 3% APY compounded into your token. But you can borrow Ethereum for much cheaper than that, because there are a lot of people just looking for single asset Ethereum yield, and you can do that in a very safe and reliable way by just lending it on well-known platforms like Aave. And so you have people that are willing to lend Ethereum for pretty cheap, let's say 1% APY. You have an auto compounding token where you're earning 3% APY just for holding it. And so you should be saying, okay, well, I could deposit this auto compounding token as collateral, borrow Ethereum for cheap, like 1% APY, swap that for more wrap state ETH, and then deposit that as collateral, and just do that as many times as the protocol allows you and your LTV allows you and you're comfortable with. And so what you end up doing is you are amplifying the yield that you're earning on Ethereum while still maintaining only 1x exposure to the underlying token, Ethereum. And so that's why it's called leverage looping. You're looping this position and you're leveraging your yield. This is different from leveraging your exposure. This would be, if you want to leverage your exposure to an asset, that would be something like using Ethereum or rep-ETH as collateral, borrowing USDC or a stablecoin, and then swapping that stablecoin for more Ethereum or rep-ETH, and then adding that as collateral. So that's regular leverage on your asset, and that is 100% directionally exposed. Like you are opinionated about the direction that you think Ethereum will go. In this case, if you are using Ethereum as collateral, borrowing USDC and buying more Ethereum, then you're assuming that you're hoping that the price is going to go up. The price of Ethereum will go up. If you're wrong, then your position will be liquidated. If Ethereum goes down, then your collateral is worth less than your borrowed amount and you're liquidated. Leverage looping is not this. Leverage looping, the two assets are the same asset. They're correlated assets. Therefore, they both move up and down together. And so your liquidation risk doesn't come from the direction of your asset. It comes from if you end up paying more to borrow the Ethereum token than you're earning from your auto compounding token. And so if that is the case and you're paying more than you're earning for a long amount of time, then that is how your borrow value is worth ends up starting to be worth more than your collateral. That's how you get liquidated. And so this is already a many billion dollar trade on Aave with Ethereum. And like why that's the case is a few reasons. One, it's very cheap to borrow Ethereum. Two, there is an auto compounding token that is scalable for Ethereum. And where does the yield come from? The yield comes from the staking yield of Ethereum. And so you put these two things together, and then it enables leverage looping at scale. And so you can now replicate this strategy with other tokens as long as you have those two things, an auto compounding token and a place to borrow the native asset, and then a protocol that allows you to do this looping. You can do it manually, but usually it's just less efficient. So usually manually, depending on the LTV constraints of the different protocols, maybe you can only get a couple loops, like 3 or 4 loops. And each loop is what dictates, how profitable is the strategy going to be. So the difference between, remember the difference between the auto compounding rate of the token and what you are paying to borrow, that multiplied by how many loops, and that's how much you're going to earn from the strategy. And so on Neutron, this has been already unlocked. This strategy has been enabled for a few different tokens, namely dATOM and Neutron, and you can do it for TIA also, but I want to talk about Neutron and dATOM because they have two different cases that I think are interesting to talk about. One, dATOM has the highest staking APR out of any of the tokens I've been talking about, and so you can hold a token like dATOM, which is by Drop Protocol, and it's earning I think 15 or 16% APY. And then you can borrow dATOM. Let's go look at the borrow rate for dATOM for 13%. So the delta there is about like 2 to 3% APY. And so every time you loop it, you're earning 2 or 3% APY on top of the regular staking APR for dATOM. And so this trade is already unlocked for dATOM. It's also unlocked for Neutron. You can see here the borrow rate is about 2.5%, and the staking APR for dNTRN is about 3%. And so that's like about a 0.5% delta. So looped up to 7 times, that's another 3.5%. And so in terms of like total yield, it changes. And it changes based on what token you want exposure to. And this is really what it comes down to. If you're doing a high leverage strategy, you're not doing it because maybe the yield for a certain, you're doing a high leverage strategy, you're bullish on the token. This is completely different to the basis trade that we were talking about previously. Basis trading, you're neutral, you don't care about what tokens you're using. You are essentially a USDC bull. In this case, with high leverage strategies, you want exposure to this token, but you're not saying that you want leverage exposure. So you want exposure to this token, you want 1x exposure, but you're not willing to, go crazy being like, it's definitely going up or whatever. You're like more of a long-term hold, but you want as best yield as possible on this token for long term. And that's why the strategy, another reason that this strategy has really picked off with Ethereum, because people are like, okay, I'm just going to do some leverage looping on Ethereum and just leave it like that for a long time. I want Ethereum exposure. It might go up, might go down, but over the long term, it's, you know, you're an Ethereum bull, and this is a good way to get like maybe 9 or 10% APY on your Ethereum, which is unheard of for a single staked token. And so you can take that same methodology over, and if you're an atom bull, you know, might go up, might go down, but over the long term, you just want some atom exposure, high leverage strategies could be for you. The same thing for neutron. You know, neutron might go up, might go down, but over the long term, you just want to get single asset exposure to neutron. And so there's other risks involved here. You know, like if the borrow rate spikes, then you end up paying more to borrow than what you're earning on the auto compounding token. And so and also you always have to compare, like, what are the other opportunities I have with these tokens? So maybe with Neutron, there's other opportunities that are better than maybe 9% APY, which is around what we're going to get with the leverage looping strategy with Neutron. For example, right now you can lock and stake your Neutron in the Bitcoin Summer campaign and earn up to 3 times the amount of rewards on your Bitcoin Summer rewards. So that might be like a better use of your Neutron than high leverage staking, but that's up to, you know, the individual to make that decision for themselves. So let's just go through the flow of how do you open one of these leverage loop positions. So we can start with so let's do the Neutron leverage loop strategy. So it shows here the range. So this is at maximum amount of loops. I would get 5.6% APR, and so APY. So that is better than just regular staking Neutron. Same thing for dATOM. At maximum, you would earn 45% APY on Atom, which compared to the regular staking rate is about, it's almost 3 times the regular staking amount. So you can see how this strategy, and this one is about 2 times the regular staking amount. So it makes sense to do these if you're long-term bullish on these assets. And you can see here in the dATOM leverage looping, it's 100% capped. So actually you can't enter this strategy. It's already full. With the Neutron one, it's about 45% capped. Okay, so we talked about leverage looping, like the history of it on Ethereum is where leverage looping first started, how it works, how the parameters you want to look out for, different applications that allow you to do leverage looping. If you want to see an actual demo here, we can go through it real quick. How much time do we have? Okay. Yeah, okay, let's go through the steps. Okay, so I'm gonna get a little bit of D and TRN so we can open this strategy. We're gonna go here to trade. We have USDC in our account, so we're just gonna go here and buy some D and TRN. We're gonna use $10 here. Okay, and then we go to high leverage. Now that we have our D and TRN, this button is clickable because we need to start with the liquid stake token. Remember, we started with wrap stake ETH on Ethereum. We're starting with D and TRN here. D and TRN is the, you know, the leverage looping, or sorry, D and TRN is the liquid stake token for Neutron. I forgot. Okay, so if you want to, yeah. So if you want to do the strategy, you actually need to start with the D and TRN tokens in your wallet. It can't be in Mars. So we have some dATOM we could probably show with dATOM instead. If you click your deposit, yeah, you see there's like a little bit of dATOM there. Okay, great. And then you would go here and you would select how much leverage you want to do, up to 7x. So this is how many loops are we doing. So let's say, you know, you want to loop it up to 4 times. It'll show here your APY. So your new estimated APY is 30% on your dATOM. You hit continue, and what's going to happen in the background is it's going to borrow a bunch of atom, swap that atom for more dATOM, and add that to your collateral. So it does the looping for you in the background. And then all you need to do is you deposit the liquid state token, you pick your leverage, and then you end up with a position, and then you just sit on that. And then when you're ready to exit, you just go and you hit close your position, and you'll end up with the dATOM on the other side. You can read here the summary. You know, your leverage is 4 loops, net APY, great, and you would just approve this and open your account. But really, like, the exciting thing that I wanted to get into, you remember, well, so let me stop there, see if there are any questions. Okay, El Blanco is asking if there's a severe DPEG event, will I get liquidated? And so that depends on the protocol that you're using to leverage loop. So the protocol that you're using can use either the redemption price of these assets or the market rate price for these assets. And so how you can get liquidated if the protocol that you're using to leverage loop is using the market price for these assets, if there's a DPEG in the liquid state token, that means that your collateral is worth like much less now. And that can cause a liquidation event. So I don't know how Aave does it for people that are leverage looping there. If you were to leverage loop manually in Mars by, you know, just putting, going here to your earn tab and putting dATOM, then this collateral on your earn tab is using the market price of dATOM, I'm pretty sure. If you go to the high leverage and you use these strategies, I'm pretty sure that that Mars is using the redemption price for dATOM. So yeah, I believe you cannot be liquidated for a DPEG for high leverage strategies in Mars, but that is a good question to confirm with whatever protocol you're using to leverage loop on. Okay, so the reason that I want to bring up leverage looping and also in tandem with the Bitcoin summer campaign I was saying that is happening on Mars or on Neutron is that previously this strategy of leverage looping has not been unlocked for Bitcoin because you don't have an auto compounding token that produces, you know, that produces yield in the token. That's what you need. On Ethereum, we have wrap stake ETH. The staking rewards from Ethereum go into wrap stake ETH and it grows over time. For you know, something like the US dollar, you have the treasury printing money, printing inflation. You know, that's why a lot of people are holding Bitcoin as a hedge against the dollar, is because the Bitcoin doesn't have the inflation that that USDC has. And so if you can take, you know, the typical treasury bill inflation of like 4% and then put that in an auto compounding token, for example, USDE, the Athena stablecoin, then you can leverage loop Athena stablecoin by doing the same thing, putting USDE as collateral, borrowing USDC, and then leverage looping. And so you can see how this trade starts to get locked when you have things like inflation on tokens and an auto compounding token. So we see this for dATOM with staking rewards from Atom. We see this with USDC with inflation from, like, you know, the national bank. We see this with Ethereum with staking rewards from Ethereum. But we never saw this with Bitcoin, and we never saw this with Bitcoin because there's no staking rewards for Bitcoin. There's no like natural yield source for Bitcoin, and there's not a lot of demand to borrow it. And so these two things combined, you have a big source of lending demand for Bitcoin, which is people are happy earning like less than 0.2% APY lending their Bitcoin. And you also don't have an auto compounding Bitcoin token. And so the Bitcoin summer campaign on Neutron is facilitating this strategy, and through a token called maxBTC, which is now a auto compounding Bitcoin token. Okay, so this auto compounding token is called maxBTC. It's earning about 5 to 10% APY, depending on how successful the underlying strategy is. During since its inception about, I think, 4 months ago, it's been earning about 6 or 7% APY, so right within the target range, and it's scalable up to 1 billion or 500 million, I think, or $1 billion at that estimated APY. And so now you have an auto-compounding Bitcoin token. And so the other piece of the puzzle is a place that you can go and leverage loop this. And so, now what we have is this protocol called Amber, which is made by the same contributors and fork contracts of this audited Mars protocol, the Red Bank protocol. And so now we have Amber, and you can deposit maxBTC, which is this auto-compounding Bitcoin token earning 5 to 10% APY, and you can borrow Bitcoin as people are lending it on Amber. So you need lending supply, which should be easy to bootstrap if people are willing to get more than 0.5% APY. And then people to do this leverage looping strategy with Bitcoin. Like, the strategy is unlocked. It's a multi-billion-dollar strategy with Ethereum. It's never really been done before at scale with Bitcoin, and now it's possible on Neutron using maxBTC and Amber. And so let's get into how to actually set one of these up. I'm not going to do the whole run through, because last week we went through a whole run through how to open it up, which positions to look at, which tokens to use as collateral. And so if you're interested in seeing that, you can watch last week's live stream. But I wanted to talk more about where this problem has come from and which specific levers needed to be turned in order to unlock it for Bitcoin. So lending supply should be pretty easy if we can overcome 0.5% APY. You need an auto-compounding, scalable, and high-yield-bearing Bitcoin token, which we have, which is maxBTC, and a protocol to do this loop at scale, which is Amber. And with Amber, you can leverage it up to 10 times. And so with the loops up to 10 times, even if you're earning 2% on each loop, that's 10% APY on Bitcoin, plus the original 5 to 10% APY. 15% APY on Bitcoin is unheard of, especially, it almost sounds too good to be true. And like I said, the people that are most interested in leverage looping are the people that don't think it's going up or down dramatically, or they don't know if it's going to go up or down, and they just are confident that in the long term it's going to perform well, and it's something they want to earn yield on. And that is pretty much exactly Bitcoin for a lot of people that are holding Bitcoin. From cycle to cycle, maybe there'll be 50%, 2x and 50% drawdowns, but they know in 8 years or next cycle it's going to be higher. And so they're just looking for, how do I compound my Bitcoin bag and not having to touch it. And so leverage looping could be the strategy for those people. Me personally, I'm excited about this and am already leverage looping some. And so this is Amber. So just really quickly, you go to Amber, you will go to, if you want to lend your Bitcoin, you can already see that the rates for lending Bitcoin are pretty attractive. This is over 1.5%, 0.73. This is already 4 times the lending rate on Aave for wrapped Bitcoin. And then if you go to strategies, this is where you would deposit your maxBTC and do your looping. And so you can see the APYs for these markets are from 25 to 55% APY. As people start to do this more and more looping, as they start to buy maxBTC and start looping it, these rates will probably come down. And so yeah, this is leverage looping. It's pretty exciting, and I'm excited to see the whole system get more liquidity. So as more people, it's a feedback cycle, right? As more people start leverage looping, the demand for lending your Bitcoin increases, because people see, oh, I can get 2% for lending my Bitcoin on Amber, I'm going to do that. And then that makes it even cheaper to leverage loop, because you have more lending supply. So then more people come in and they start leverage looping their maxBTC, which again puts more demand to lend your Bitcoin. And so they work very well in tandem. And it's this relationship between the different people on the risk curve. There are some people that don't want to leverage loop. They just want to lend, one token, lend their Bitcoin, and keep it simple. They don't want exposure to, if something happens and maxBTC stops making yield because the strategy is no longer profitable for 1 month. I think that's pretty rare. But we don't know. maxBTC was just like just started being yield bearing maybe 5 months ago or something. So the history is not years long. And so, and what if someone pulls out a bunch of lending supply for wBTC? That might make it more expensive to borrow wBTC. And so maybe the lenders are happy not worrying about those risks and instead earning a much lower rate on their wBTC. However, there are other people that are more comfortable with those risks. Maybe they're more attentive, they're checking their portfolios every day, and those people are like, yep, give me the 50% APR on my Bitcoin. And the relationship between those two types of investors is what drives leverage looping. And it's like very easy to see that on Neutron and see that relationship come together. So I'll stop there and see if you guys have any questions from the YouTube or from the Twitter live stream. So what do you guys think about leverage looping? Are you interested in in doing leverage looping yourself, or maybe you already have a position? In case anyone wants a reminder, I do want to just show you the UI for Bitcoin Summer. And so if you have wrapped BTC on Ethereum, it's really easy. You can bridge it to Neutron just by going here to app.neutron.org and bridge and swap. And this bridge, you can put in the Ethereum network and the wrapped BTC token. This little icon, Bitcoin Summer, shows that it's the right one. Bridge it to Neutron. Last time I did it, it cost me $3 total, so super cheap. And then you can take that wrapped Bitcoin and deposit it directly into most of these positions here. And then the APY here that you see is the top. This is, for example, lending wrapped BTC on Amber, and you'll see that the top indicator pool APY is the actual yields you get from DeFi. And so this is 0.73% native Bitcoin compounding from lending your Bitcoin. And then below that, Bitcoin Summer 3x, those are the rewards that you get from this campaign. So Neutron is bootstrapping the Bitcoin DeFi, Bitcoin finance economy on Neutron, and they're doing so with this campaign, which is in Neutron rewards. The rewards that you earn from the campaign are subject to a few different restraints, and you can learn about them here with this Learn More button. You can learn about the campaign, but the main constraints are each phase is 2 months long, so 60 days, and you need to keep the funds in the campaign for until the end of the phase, and that will allow you to claim the rewards. So if you deposit and then remove 10 days later, whatever you earned for those 10 days is forfeit. And so it's a soft lock mechanism where you'll forfeit your rewards, but you can withdraw at any time. So your funds are not locked in the protocol. The other stipulation is when you go to claim your rewards, you'll have 3 options. So your rewards are denominated in dollars, and at the end of the month, or at the end of the phase, which is 60 days, you'll have 3 options for claiming. One of them is claim 100% of your rewards vested linearly over the next 60 days. The second option is claim 50% of your rewards right now and forfeit the other 50%. The third option is claim 100% of your rewards and stake and boost your rewards. So what do I mean by stake and boost? Up here in the top left corner, you can stake Neutron and boost your Bitcoin Summer rewards. And so this is what I was saying earlier, that maybe there's other uses of Neutron that are more effective than high leverage strategies for Neutron. And so in this case, maybe you want to stake and boost your rewards. And so the formula right now, might change. Is, say, this APR is I'm earning 20% APY for lending wrapped Bitcoin. If I deposit $100 into this lending and I stake and lock $100 of Neutron for 4 years, that is the maximum multiplier, which is 3 times. And so I would now earn 60% APY on this position. And so it incentivizes people that are you know, they think Bitcoin finance is the next step for Bitcoin, and you know, this narrative is going to expand. Neutron is going to ultimately win this narrative because of leverage looping, because of maxBTC, because of the system that they've created, and therefore they're willing to lock up Neutron and align themselves with the network. They're going to be repaid handsomely by earning ridiculous yields on their Bitcoin. And so those are the three options, and those kind of the constraints of the Bitcoin Summer Campaign rewards that you should be aware of. One final thing about the campaign is that each of these buckets of rewards is not like a single bucket. And so some people say, oh, there's only $20 here and it's earning 13% APY. If I add, you know, if I add $1,000 here, the yield will be almost nothing. And that's not how the campaign works. The campaign is incentivizing all the positions with like one bucket of rewards, such that the market gets to decide where they want to allocate funds. So if, you know, people are interested in unlocking the solve BTC leverage looping strategy, then people can start depositing into this pool, into lending solve BTC, and they'll be earning the same amount of rewards as other positions, the same APY. So of course, right now the TVL is like 16 million. If another 16 million enters the campaign in it doesn't matter what specific position. So if another 16 million enters the campaign, then all the rewards you see will be cut in half, because there's now twice as much TVL in the campaign. And so that's how the campaign works. I want to hear from you guys if you're already in the campaign. I know some of you in the audience are participating already, and the first phase is ending. And so if there's anything that maybe you would like to see different about the second phase, then I want to hear from you, and I can forward it on to the team. I know there are already some changes that might take place based on community feedback, and so we are listening, and we want to make the campaign as successful as possible, not just for Neutron, but also for the community of Bitcoin finance holders. So I'll stop there, give you guys a few minutes to think of any last minute questions or anything you wanted more clarity on, and then we'll close it out, and I'll see you guys next week. So yeah, thank you everyone for coming in the YouTube. You know, Eddie, thanks for your questions on basis trading. That helped me think of what to talk to you guys about today. And yeah, if you ever have like anything else you want to be brought up in this class, just you can message me at FluffyTrex on Twitter, or if you join the Neutron community Telegram, then I'm there all the time. So you can find us on X. I think it's in the description of this video down below. You can see the official Twitter accounts for the various protocols that I mentioned, and so the one for Neutron, you'll find our community channels. Okay, so I'll leave it there. Thanks a lot, guys. Thanks for coming, and thank you, YieldLab, and we'll see you next week.